Hi there, I'm Suk Day. In this tutorial, I shall discuss IAS 33. IAS 33 deals with the calculation and presentation of earnings per share or EPS. It applies to entities whose ordinary shares are publicly traded. So the tutorial topics would be 1. To outline what the main provision of IAS 33. We will then look at how EPS presented in a PLC company, and then we'll work through some numerical examples of EPS calculations, and finally we will look at an exam type question. One of the most commonly used performance measures worldwide is the basic earnings per share. And that is the profit or loss due to the ordinary shareholders divided by the number of ordinary shares. So you get an earnings per share. When companies report the annual earnings, what gets prominent in the financial press is the EPS. And that is compared with the market's expectations of the EPS. The EPS is also a component in the price-earnings ratio, which often forms a pivotal role in the valuation of business. Let's have a look at this ratio. So the PE ratio is the share price divided by the EPS. So you could say that the share price is a multiple of its annual earnings. And that could be 10, could be 15, and it could be sometimes 30 in the case of companies that are expected to grow earnings quite a lot in the future. IAS 30 requires company to calculate the weighted number of ordinary shares in issue in an accounting year where it has made the following types of issue. Bonus issues, which are free shares to existing shareholders. Rights issues to existing shareholders at a discounted price to raise finance. Many companies also now award what you call share options to employees that will vest in the future date, or have issued debt which are convertible to ordinary shares in the future. In such situations, the entities concerned will compute a diluted earnings per share. So again, how do we work out the diluted earnings per share? Again, it's the profit or loss due to the ordinary shareholders, and that is divided by the existing shares plus the potential share capitals, share issues, which is what the weighted average shares in one single number. Where companies have trading operations which have been discontinued during an accounting year, the entity has to calculate 3 EPS. One is the basic EPS, then is the continuing EPS, and the third one is the discontinuing EPS. Right, in this slide we will look at Smith PLC. It is a British multinational diversified engineering business headquarters in London. I will just show you how it presents its earnings per share. Now, what I want to draw to your attention is that the profit for the year for this group, which is 1.035 billion, is divided up into two parts. One is the profit due from continuing operations, which is 13 million. And then there is the profit from discontinued operations, which is 1.022 billion. discontinued operations represents those business that the group has disposed of, and together they have the profit of 1.035 billion. Now, it's also important to understand how that profit for the year has been allocated between what is called the non-controlling interest, and this is the portion of the shares not held by the group in the subsidiaries that the group has, which is 2 million, and the other two, the balance, is divided up between the group's continuing operations and the group discontinuing operations to give us the profit for the year. Now let's look at how it calculates the first EPS, which is the basic earning per share, which is expressed in pence, which is 267.1 pence. And here you have the profit due to the group, which is 1.035 billion, take away 2 million to give us 1.033 billion, and that is divided by the average number of shares in issue to give us the basic EPS, again expressed in pence. We also have the basic diluted EPS. The numbers that have changed here is the diluted average number of shares, which has increased to 388, 349, 758 number of shares, and you can then have the basic diluted EPS, which is 266 pence per share. And finally, we have the basic EPS continued operations. Again, the same calculations, the profit for the year divided by the average numbers of shares in issue, and the number is small, which is 2.8, simply because the profit from the continuing year is 11 million. In this slide, we will look at bonus issues. These are additional shares issued to the ordinary equity holders in proportion to their current shareholdings. With bonus shares, no cash is received from these shares, and we do the following accounting entries. A credit is made to the share capital and a debit to the share premium or retained earnings. For a bonus issue, the treatment for the weighted average number of shares is to assume that the shares has always been in issue. What does that mean? This means that they should be treated as having been issued at the start of the earliest year period for which results are reported, usually the start of the year presented as the comparative figures. Let's look at an example. XPLC has 10 million ordinary shares in issue on 1st of January 20X3. Its accounting year end is 31st of December, and its earnings for 20X3 is 10 million and 20X4 is 13 million. We also are told that 2 million bonus shares are issued on 1st of October 20X4 in the accounting year 20X4. So the question is, what is the basic EPS amount that was presented in the 20X3 financial statements? So to work this one out, it's quite straightforward. 20X3 we made a profit of 10 million. We had 10 million ordinary shares in issue, and that gives us 100 pence per share. Now, in 20X4, you will have to calculate two basic EPS. One is the one for the comparative figure, which is 20X3, and for 20X4. So, for 20X4, the EPS is the 13 million profit for the year, But because there was a bonus issue, the total number of shares is 10 plus 2 to give us 12 million, and that gives us 83.3 pence. In 20x3, which is the comparative EPS, which will be shown in 20x4's annual report, it will be taking the 10 million profit, but now divided by 12 million. Because where bonus issues have been made, they are assumed to have been issued at the start of the earliest period. So here the earliest period is the beginning of 1st of January 20x4, and that gives us a figure of 108.3. Now let's look at a rights issue. Rights issue is an issue of shares for cash to the existing ordinary equity holders in proportion to their current shareholding, and it is at a discount to the current market price to encourage take-up. Because the issue price is below the market price, a rights issue is in effect a combination of an issue at full value and a bonus element. So in order to calculate the basic EPS number of shares where there has been a rights issue, an adjustment is required for the bonus element. This adjustment is to divide the pre-rights fair value of a share divided by the theoretical ex-rights fair value, or TERP. The pre-rights issue price of the share is the market price immediately before the rights issue is announced. The theoretical ex-rights fair value is the theoretical price at which the shares would trade after the rights issue and takes into account the diluting effects of the bonus element in the rights element. This adjustment thus increases the number of shares in issue before the rights issue for the bonus element. Let's look at an example. We have Box plc, which had 10 million ordinary shares. On 30th of June 20x9, Box plc made 144 rights issue at £2.40 per share. At that date, the market price before the issue was £3.20, £3.20 per share, and the earnings of the company was 4.8 million for 31st December 20x9, and we are required to calculate the basic EPS for 20x9. So the first step is to calculate the theoretical ex-right price of the ordinary shares after the rights issue, or calculate TERP. Then apply the fraction, which is the pre-rights X price divided by the X-right price, to the shares in issue before the rights apportioned for time. The total number of shares we don't have to calculate after the rights issue, and finally we then work out the weighted average numbers of shares, which is the sum of 2 plus 3. So Box plc on 1st of January had 10 million shares. It made a rights issue on 30th of June, 1 for 4 rights issues. So the 4 shares, which were the pre-rights price, which is £3.20, comes to £12.80. Then we had 1 share, which is the rights price of £2.40. We added on to £12.80 to give us £2.40, and we then get a total of £15.20. To work out the TERP, or the theoretical ex-right price, we take the 1520, which is the total number of shares divided by the total number of shares after the rights issue, which is 5, and we get a theoretical ex-right price of each share at £3.04. Now, the total number of shares after the rights issue is a 10 million plus the 2.5 million rights issue to give us the total of 12.5 million shares. So the weighted average number of shares at the end of 20x9 is a 10 million, which is then adjusted by the pre-rights price and the rights by the TERP and proportioned for time, and that gives us 5.263158 million shares. We then have the number of shares in issue, which is 12.5 million after the rights issue, apportioned for time, and that gives us 6.25 million, and the total or the weighted average number of shares is 11.5131.58 million. The EPS is therefore to divide the 4.8 million, which is the company's earnings in 20x9, divided by the weighted average number of shares, and we get EPS of 41.7 pence per share. Let's look at an example of an exam type question. Kappa Limited is a listed company that made a profit after tax of 35 million for the year ended 30th of September 2010. There were no discontinued operations. At 1st of October 2009, Kappa had 70 million ordinary shares and 30 million preference shares in issue. So this gives us the details of the share capital of Kappa. In the year ended 30th of September 2010, Kappa declared and paid a dividend of 12 cents per share to the ordinary shareholders and 6 cents per share to the preference share capital. The preference dividend will have to be deducted from the profit after tax to arrive at the profit due to the ordinary shareholders. On 31st of December 2009, Kappa made a fully subscribed rights issue of 2 ordinary shares for every 7 held at $1.35 per share. The fair value of an ordinary share 31st of December 2009 was $1.80. So details of the rights issue, and this will affect in your calculation of the weighted average number of shares. Now, throughout the financial year, Kappa had 20 million convertible loan notes on which interest of 5% per loan was payable annually in arrears. The carrying value of the liability element of the loan note at 1st of October 2009 was 23 million, and the effective rate of interest was 7%. Now, when we calculate the interest payable on the loan notes, we have to take the 7% as the effective rate according to IFRS 9. The rate of income tax to the jurisdiction in which Kappa operates is 20%, and the finance cost that is charged to the statement of comprehensive income tax is subject to income tax at that rate. And finally, the loan note are convertible to ordinary shares from 1st of October 2011 at the option of the note holder. So the conversion terms are 1 ordinary share for every loan held. Now this bit of information will affect the diluted EPS, not the basic EPS. the loan interest will have to be added back to the profit after tax, and the number of shares increased by 20 million after conversion. As I said, this information will impact the weighted average number of shares for the diluted EPS. Right, so we've got this problem here. We're going to look at kappa, but only going to work out the basic EPS first, and then we'll work out the diluted EPS. To work out the basic EPS, calculate the profit for the year after deducting the preference dividend. Calculate the theoretical ex-right price. Compute the weighted average shares after the rights issue. And 4, compute the basic EPS. So first, step 1, the profit for the year, we're given as 35 million, which I have underlined on the text. We take away the preference dividend, which is 6 cents per share, multiplied by the number of shares, which is 30 million, and we get a preference dividend of 1.8 million. So the basic EPS, which profit attributable to the ordinary shares, is 33.2 million. Step 2, calculate the theoretical ex-right price. So the share price before the rights issue was at $1.80, and there were 7 shares, so that works out at $12.60. The rights price was at $1.35, and there's 2 of them, so that works out at $2.70. The total number of shares is 9, and the total the share price before the rights issue and the rights price come to $15.30. So the theoretical ex-right price is $15.30 divided by 9 shares, and you end up with $1.70. Step 3, work out the weighted average shares. So we had 70 million shares, which has to be adjusted prior to the rights issue by the adjustment factor, which is the share price before the rights issue of $1.80 divided by the share price after the rights issue, which is $1.70, and then you apportion for the time factor, which is 3/12 to give us 18.529, and then we take the the total number of shares after the rights issue, which is 90 million, apportioned for time again, and that gives us 67,000 or 67,500,000. So altogether, the basic EPS, weighted average shares, is 86,029 shares. Step 4, we divide the basic EPS, which is 33.2 million, divided by the weighted average shares of 86,029 million, and that gives us an EPS, basic EPS of 38.6 pence. Right, now we're going to work out the diluted EPS. For that, we have to look into this bit of information here, where the company had issued 20 million convertible loan stock, and they would be converted sometimes on 1st of October 2011. And as far as adding back the additional the interest on the convertible loans, we have to take the carrying value of the liability, which is shown in the question as 23 million, and the effective rate with the effective rate of 7%, and the after-tax cost. So we're going to multiply the 23 million times 7% times 80 as the amount to be added back. So you have the interest on convertible loan added back as 1,288,000. So the profit after tax for the diluted EPS calculation is 34,488,000. Step 2 is not necessary to work, has already been worked out, which is the theoretical X price, and it relates to calculating the weighted average shares. And now we go to step 3, where again we've already worked out the weighted average shares before the conversion of convertible loan notes was 86,029,000. We assume that the convertible number of shares that would be converted to ordinary shares is 20 million, and that gives us the diluted number of, or weighted average diluted number of shares to be 106,029,000. So the last part is to actually work out the diluted EPS, which is to take the 34,488,000 profit divided by the diluted number of shares, and that gives us a diluted EPS of 32.5 pence.